Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, and thank you for joining me today to discuss 3 strategies to help manage your emotions during volatile markets. My name is Steve Brice, and I run Standard Chartered's Wealth Management CIO office. So markets have clearly had a rough start to 2022 as inflation accelerated globally and global supply chains have been pressured by the lockdowns in both China and also obviously the Russia-Ukraine conflict. Of course, this is not the first time that we've seen such volatility, and it certainly won't be the last. Managing your emotions, especially during such challenging environments, is the key to long-term financial success. And we see some time-tested principles that can absolutely help you achieve this and ensure that your financial plan does not get knocked off track. So while everybody is different, we believe there are 3 things that investors should bear in mind when investing, especially in volatile times. So the first thing is to understand that while weakness in equity markets can be dramatic in terms of both the size and pace of losses, these periods of weakness are generally short-lived. So if you look at the probability that global equities will generate positive returns using data from 1988 to 2020, we can see that the probability of positive returns rises from 60% over a 1-month time horizon to over 91% over a 10-year time horizon. So you can see the longer that you have the time horizon, it means really that the larger the proportion of your portfolio should be allocated to equities. It also means, of course, that selling equities after market declines can often be the worst thing an investor can do. This leads on to the second thing to bear in mind. When we experience financial loss, we experience emotional pain. This risks us taking irrational actions. The probability of positive equity market returns actually increases after a sell-off, and therefore you can make the argument that you should increase your allocation to equities after such market declines. Unfortunately, we're all wired in a way that the brain tells us to either ignore this opportunity that's been created by market weakness, or even worse, get rid of the problem by selling equity holdings altogether. It can be reinforced, of course, because when markets are weak, we're generally seeing negative news flow that comes through on all the news channels, TV stations, etc. So therefore, from an investor perspective, it's really important for us to be aware of these biases and try to get the right balance between understanding what's going on in markets and also sticking to your long-term financial plan. And this leads neatly into the final point I want to discuss, which relates to diversification and risk tolerance. So market volatility can often expose weaknesses in our portfolios when it comes to diversification. And rectifying this can often be costly as the asset that you have insufficient exposure to has actually rallied in price, making the entry point more expensive. Now, I use this in inverted commas. The good news, obviously the bad news, is both equities and bonds have weakened, but that does mean that the cost of the medicine, which is reducing exposure to one asset class and raising it to another, is actually a lot lower than it would normally be. And therefore, really, if you find that you've got slightly imbalanced allocation to what you think you should have, there's really no excuse to not rebalance in this environment. So that's all we have time for today, but I hope this helps you build a robust portfolio going forward and also achieve, obviously, your financial goals. As we mentioned, the key to investing is having good foundations and a robust investment plan, but it is often overlooked. So please reach out to your Standard Chartered relationship manager to help you put that in place if you do not already have one. In the meantime, if you're not already, I suggest you follow the Standard Chartered Wealth Insights LinkedIn page, where we have a weekly blog from the Standard Chartered CIO office talking about our investment views, themes, or strategies to help you manage your emotions. 2 blogs that spring to mind in recent times and that relate to this podcast are Stop Losses Are for Wimps and Silver Lining for Non-Diversified Investors. Please feel free to look these up. In the meantime, please follow, rate, and like our podcast channel, and I will speak to you again soon. And if you have any feedback on our different podcast series, please feel free to reach out to me directly on LinkedIn. Thank you so much.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.